Dollar cost averaging versus lump sum investing. Which is better? Obviously, you know Warren Buffett, he always says that an average investor should follow the dollar cost averaging strategy because no one can really time the market. That is some really good advice, and I personally feel that this strategy will be the better option for most people, and that is why our own 401ks or retirement annuities or government employee pension funds uses this exact strategy because it ultimately reduces risk. If you have money to invest, you need to decide if you want to space it out or put it all into an investment now. In this video, we are going to discuss which of the two strategies is the best, which one will work better for your personality, and at the end of the video I'm going to share which one I prefer and the one that I have been using with great success. So if this is something that you want to find out, make sure to stay until the end of the video. So the question is, does it really matter which one you choose? Before we answer that question, let's jump into what is the difference between dollar cost averaging and lump sum investing. The main difference between dollar cost averaging and lump sum investing is when you invest in the stock market. With dollar cost averaging, you invest small amounts of your money at certain intervals over the course of time. Lump sum investing, on the other hand, is when you take all of the money you have available to invest at that specific moment and invest it all at once. I'll discuss these two in a little more detail. So let's start with a brief description of dollar cost averaging. Investing your money at regular intervals such as weekly, monthly or quarterly in things like stocks and ETFs is considered dollar cost averaging, often referred to as DCA. So most of us has set up a 401k or a pension fund contribution at our jobs, and money is automatically taken out of our paychecks and invested in a variety of funds. If you've done that, you've used the dollar cost averaging strategy. Just remember, this is basically what your government employee pension fund does. While that is the most common method of dollar cost averaging, you can take another route with dollar cost averaging. If you have a lump sum of cash in a savings account, for example, you can elect to spread that money out over a certain period of time and invest it gradually. For example, if you had $20,000 or 20,000 Rand in a savings account, you could spread that out over the course of 12 months evenly, instead of investing that 20,000 Rand or $20,000 all at once. The major draw to this strategy is that you aren't putting every dollar you have into the stock market at once and taking the risk that the market will suddenly drop and so will your portfolio's value. This is a fear that a lot of investors have. Since past performance is nothing more than a piece of data and no one can predict the future returns, dollar cost averaging helps you mentally invest your money into riskier investments like stocks and ETFs without feeling the risk as much. Okay, so here's a brief description of lump sum investing. Lump sum investing, on the other hand, is when you take all of your available dollars or rands to invest and put it right into the stock market all at once. It's literally the opposite of dollar cost averaging, so you don't wait to invest, it all goes into your chosen investment right away. Now, there is somewhat of a fine line between dollar cost averaging and lump sum investing. Let me explain. If you are intentionally holding on to cash to invest it later, I would chalk it up as dollar cost averaging, but you can still make periodic investments and consider it as lump sum investing. For example, say you get a quarterly bonus from your company of 10,000 Rand or dollars. Every time you get that bonus, you decide to invest it. this is still a lump sum investing, even though you're making periodic investments. The reason is that you're not intentionally holding on to the money for a later time. If you were to instead take the 10,000 Rand or dollars quarterly bonus and spread it out over the coming quarter in 3 equal monthly installments, that would be dollar cost averaging. It might seem like semantics, but when you look at the data, the difference can actually mean more or less money in your portfolio. More on this later. So who is dollar cost averaging for and not for? Dollar cost averaging works really well for nervous investors with lower risk tolerance and who have larger sums of money sitting around in something like a high yield savings account or a money market account. You can minimize your risk by spreading out your investments into smaller chunks while still keeping your cash in a safer investment such as a money market account. You'll also benefit from dollar cost averaging if you can spread your investments out for a longer period of time. If you invest your money too quickly, for example, over 1 or 2 or 3 or even 6 months, you may not give the market enough time to correct itself after a big upswing or downswing. Coronavirus is a great example as things have been volatile and you won't get the most value from dollar cost averaging approach if you invest it too fast. I recommend spacing it out over 12 to 36 months. If you're taking this approach, I would recommend setting it up as an automatic investment plan so that you don't bail out on your contributions by doing it manually. On the flip side, and this is where it gets interesting, dollar cost averaging isn't for those who want to invest faster and are okay with the ups and downs of the market and don't like keeping extra cash in lower yield vehicles like cash deposits or bonds or money markets or whatever. So who is lump sum investing for and not for? Lump sum investing is a strategy that requires a very high level of risk tolerance and you really need to have the emotional intelligence to stay course when investing a lump sum. If you have $20,000 or 20,000 Rand to invest, a lump sum investing strategy would tell you to dump all of that money into your investment at once. By doing that, you run the risk that the stock market can tank immediately after your investment. Just imagine how bad that must feel. Alternatively, it can also go upward, and this is where you can make massive returns. For anyone that has followed me for a while, you would have probably seen the video where I invested a lump sum in Sasol, and I really did get a good return from that investment. This just kind of gives you the idea of what I personally like, but more on that later. Obviously, you need to have the correct emotional intelligence, and this is something that I really like to talk about as well. While there is an inherent risk, there's also the possibility of huge gains. Imagine you'd invested 20,000 Rand or $20,000 right after the stock market tanked. You'd have enjoyed the ride of a significant market rebound. Likewise, if you're uncomfortable with the risk of losing your investment, or if you want to have some extra cash set aside for emergencies, instead of being invested, lump sum investing probably isn't for you. Besides all of the stuff that I'm sharing, you should anyway always have an emergency fund before investing into the stock market. Even if you could bring yourself to make the investment, people who are internally uncomfortable with it will experience anxiety and make emotional-based trading decisions, which is never good. I've seen countless investments that has gone real bad real quickly because the person that invested really didn't have the patience or the emotional intelligence. So the question now is, does it really matter which one you choose? Yes and no. No, it doesn't matter from a personal and psychological perspective. But yes, it does matter from a data and mathematical perspective, which in my opinion is very important. Here's what I mean. I like to equate this argument to Dave Ramsey's argument of the debt snowball. Mathematically, the debt snowball makes no sense, and Ramsey suggests paying off your smallest balance first, then your next biggest one, and so on. This approach completely ignores interest rates, so you're not necessarily taking the most logical approach, but it works on a psychological level. That to me is where dollar cost averaging wins out over lump sum investing. Mathematically, it doesn't necessarily make sense. I'll tell you why in just a moment, but it brings a level of psychological safety to your investment strategy by allowing you to keep cash on hand in case of emergencies and invest some money along the way. With that said, this is again if you are someone that's really risk averse. So I've researched one or two studies, and what the studies show is that just like any investment strategy that aims to reduce risk, like investing in bonds because it's safer, for example, dollar cost averaging has downsides as well. Put simply, a dollar cost averaging investor will miss out on massive swings in the market because they're keeping their money aside for the next deposit. By the time the money is ready to be invested, the market may have already corrected itself and you've missed out on that gains. If you miss out on a week or even 2 weeks, that can make a massive difference in your returns. One study done by two professors of finance in the early 90s looked at historical stock market data spanning around 70 years, and their findings showed that around 67% of the time, someone who invests a lump sum gained higher returns in their first year than someone who followed dollar cost averaging and drip fed their investment over the course of the year. Another study that was done more recently by Vanguard looked at the difference between dollar cost averaging and lump sum investing by investing in a 60-40 split, 60% stocks and 40% bonds portfolio in 3 different countries. They found that in each market, a lump sum investment led to greater portfolio values approximately 2/3 of the time. They did variations of this test and saw very similar results. What they're saying is that dollar cost averaging from a statistical perspective isn't all it's cracked up to be. It provides some level of safety, but at the cost of increased returns. So I personally use the lump sum investment strategy because it suits my personality. I love taking calculated risks, although it may seem risky at first. Being a long-term investor removes a lot of the emotional stress from the equation. There is no wrong or right to invest because it will be different for everyone, and I hope that the info that I shared with you will help you to determine which strategy will work better for your personality. If you are someone that is really interested in making big gains, lump sum investing might be better. If you are someone that's more conservative and risk averse, dollar cost averaging is definitely the way to go. With that said, guys, thank you so much for watching. I'm looking forward to making another insightful video. If you like this video, subscribe to my channel and I'll see you guys in the next one.